Okay, Prashant, should I start? Okay, so we are all set. Good evening to all of you. I welcome you all to this webinar. In particular, I welcome Professor Masaki Mori, EHL Switzerland, to the Misra Center for Financial Markets and Economy at IIM. I am Abhiman, a professor in the economics area of IIMA and currently chairing the Misra Center. This center undertakes primarily applied policy-oriented research on financial markets and economy, and covering various issues like market structure, regulation, real estate, central bank mandate, fiscal development, accounting, finance. I think various other related issues, including banking and bond markets. And of late, we are also working on issues relating to financial inclusion. So we are also engaged with relevant stakeholders by conducting conferences and workshops on a regular basis. Due to COVID, this has been halted a little bit, but we have started that process again. We also run another parallel webinar platform for the young PhD students to share their early research. So it's an area where we suppose we bring together both the young PhD students along with faculty and experienced faculty to share their research. With this brief introduction of the center, I hand it over to Professor Prashant Das to take it over for the webinar today.
Thank you, everyone. Good evening, ladies and gentlemen. Today we have representation from different parts of the globe. I am your host, Prashant Das. I'm an associate professor in the finance and accounting area of IIM Ahmedabad. Today we host Dr. Masaki Mori from EHL Lausanne, Switzerland. You might have heard of another Masaki Mori, the manga artist from Japan. But our guest today is the superstar of real estate research. He is among the top 25 real estate researchers in the world, according to the American Real Estate Society. He has earned teaching excellence awards from the National University of Singapore and numerous research awards and grants internationally. Dr. Mori is also a Fulbright Scholar awarded by the Japan-United States Educational Commission. And before moving to Switzerland, he served as the Dean of Graduate School at the International University of Japan, as a faculty member at NUS Singapore, and as the Director of Graduate Program in Real Estate at the University of Reading, UK. He teaches and researches about real estate finance, mortgage banking, REITs, investment, portfolio management, derivatives market, and debt securities markets. He has published numerous articles in premier real estate journals, and he earned his BA in financial engineering from Keito University, Japan, and worked with Nomura Asset Management for several years before starting his PhD at the Robinson College of Business, Georgia State University in Atlanta, USA. So let's do it the States way. The Japanese financial system is characterized by business groups called keiretsu. Keiretsu is a business group of rather heterogeneous companies, including banks, that share risks with each other. And Dr. Mori will present his research today describing how some REITs benefit from their keiretsu affiliation than other REITs. The presentation will last for nearly 1 hour, after which we shall have a 15-minute session for Q&A. If you have any questions or comments while he's presenting, please post them in the chat box, and I will post them to Dr. Mori when appropriate. Dr. Mori, we hope you will not mind if I interrupt your presentations to pass on the questions or comments to you.
Please do interact.
I ask you to claim the center stage. Dr. Mori.
Thank you very much, Prashant, for your very kind introduction. It is my honor to present my research at this prestigious institution. So thank you very much for your invitation. Now let me share my screen. Okay, so Before starting, I'm just recovering from the cold. So I apologize in advance if it's uncomfortable to hear my noisy voice, but I try my best. So for this research, I have two co-authors, So Wen-ong and Joseph Hui, both from National University of Singapore. Okay. Okay, so as Prashant briefly introduced, this is about the business group affiliation called keiretsu in Japan and real estate investment trust. In many Asian countries such as India, Japan, South Korea, Thailand, and Singapore, and Latin American countries such as Brazil and Mexico, we often observe groups of closely tied corporations. Some groups were formed because of a common history background, and other groups were formed because of their relationship with the government, like the government-linked corporations we observe in Singapore. At the same time, in these countries, new real estate investment trust markets have been developing. So we are connecting these two factors together. So in short, the main message from this research is that it seems important to consider the effect of business group affiliation when we examine profitability and appropriate management system of the REITs in these countries. As a most notable effect of a business group affiliation, Aoki proposed risk-sharing hypothesis that posits that business groups enable member firms to share risks by smoothing income flows and reallocating money from one affiliate to another. And many papers tested this hypothesis empirically, so these studies, and the main findings include these 2 points. The variance in operating profitability and growth rates is lower for business group affiliated companies than for business group unaffiliated companies. And also they found that profitability itself is lower for business group affiliated companies than with unaffiliated companies. But they often find that this profitability lower profitability itself is not statistically significant. So not really a big difference in profitability itself, but variance of profitability is much lower with corporations affiliated with the business group. So these are main findings. So implications from past studies findings include these 3 points. So member firms try to rescue other firm when they are in trouble. And when the member firm is enjoying extraordinarily good profit, they might also exploit other members. And in the end, they try to enjoy stable growth as a group in the long run through implicit and informal mutual insurance arrangement. So basically, we test this business group's risk-sharing hypothesis looking at the REITs. So now I'm going to explain why we focus on REITs. Okay, I said the REITs, but among REITs, we focus on externally managed REITs we often observe in Asian countries. So as of today, almost all REITs are externally managed in many Asian and some other developing countries. On the other hand, if you look at the US REIT market, almost all REITs are internally managed. I'll explain the difference a bit more in a minute. So this picture shows the externally managed REITs, which is the focus of our study. So here you see the REIT, but with the externally managed system, the first thing to note is REIT is almost like a box. Main operations do not happen inside of this REIT. Okay, and also we have a sponsor. So these are REIT sponsors are typically publicly listed real estate developers, real estate service companies, retail companies, and financial institutions. And the REIT sponsor is a creator of a REIT that sources the properties placed into the REIT at the time of IPO. Okay, and as shown in this figure, a REIT asset management company select properties, execute investment strategies, and hires property managers. Okay, so REIT hire asset management company, and most decisions are done by asset manager, and asset manager hire property managers. But in this structure, both this asset management company and property management companies are often wholly or partly owned by the sponsor. Okay, so with this structure, it's clear that the sponsor has a great influence over all aspects of REIT operations, right? They control asset management company, property management company. They make decisions for REIT. And one big issue, especially discussed in the US, is this sponsor is a listed company. The REIT is also a listed company. There may be a conflict of interest between shareholders of this sponsor and the shareholders of REIT. So especially at the beginning of the Japanese REIT market, for example, many American investors said, we're not going to invest in Japanese REITs because REITs are structured as externally managed REITs. And even in the US, if you look back the history, at the beginning of REIT market, most REITs were externally managed. But through the history, the US market found that externally managed REIT has many issues and performance is worse than internally managed. So that's why in the US, almost all REITs are now internally managed, which means these asset management function, property management functions are embedded into this REIT itself. Okay. But in Asian countries and other new developing countries, we still see this externally management, the REITs. Okay. And in these countries, behind this REIT structure, we have closely tied business groups like a keiretsu in Japan. And some of the sponsor of REIT belongs to business group, and other sponsors of REITs do not belong to any big business group. So because sponsor has a great power influence over the REIT operation, so whether a sponsor belongs to this business group or not should affect the operation profitability of this REIT. Okay, so that's why we look at this externally managed REIT in testing risk sharing hypothesis.
Quick question, Dr. Mori.
Yes.
In Japan, do the REITs have to be listed?
No, in Japan, private REITs are possible.
They are possible.
Yes.
Because in India,
and we have. Okay.
Okay. Thank you.
And I think if I remember correctly, in the UK, all REITs should be public. So depending on the country, yes. And actually in Japan, as of now, all REITs should be externally managed. But for example, if you look at Singapore, both externally managed and internally managed REITs are allowed. But if you look at the situation, almost all REITs as of today in Singapore are externally managed. So that's the situation.
So sorry to interrupt, but in India also REITs must be externally managed.
Okay.
And they must be listed. So as a side note, in December, we are going to organize a panel discussion where we will bring REIT executives from India and the US to come up with these discussions.
Okay, yeah, sounds great. Okay. So this picture just illustrates the business group called keiretsu in Japan. So these ships are independently managed corporations, but they are actually tied to each other like this. And when the one corporation is in trouble, other company try to rescue. And when the other corporation is enjoying profit, the other company might try to exploit. But in long run, as a group, they try to enjoy stable growth. So that's the kind of a spirit behind keiretsu. So now let me also introduce one personal episode to tell you the effect of keiretsu. So my father used to work for Sumitomo Bank, which is a core member of one of our big business groups in Japan. And when our family went to restaurants, and my father found that the Asahi beer was not available at the restaurant, he often called the owners and said, why don't you also have Asahi beer at your restaurant? Then our family will come back again. He was saying that because Asahi Brewery belongs to the same business group as Sumitomo Bank. So my father, of course, drinks only Asahi beer, Asahi Super Dry, to be specific, at home. So like this case, effects of a business group can be observed even in our daily life in Japan. So more formally, keiretsu has a root in zaibatsu, which is a pre-war family-controlled monopolies. And this zaibatsu controlled a large portion of the Japanese economy. For example, it is reported that in 1930, 4 large zaibatsu groups, Mitsubishi, Sumitomo, Yasuda, and Mitsui, controlled approximately 75% of Japan's economy GDP. But after the World War II, the American occupational forces decided to dissolve the zaibatsu, claiming that the groups were responsible for the war through the cross connection between their group subsidiaries in heavy industry and the Imperial Japanese Army. And the shares owned by controlling families of zaibatsu were confiscated and sold to individuals. So basically, that's the end of zaibatsu. But after the stock market reopened in 1949, the former core members of zaibatsu, which are often banks, they started buying shares in a stock market, shares of former members of zaibatsu through the stock market, which was the beginning of this informal group of independently managed firms, so which are called keiretsu. And the keiretsu group has banks, commercial banks as a core member. And in 1990s, it is reported that the significance of keiretsu in Japanese economy generally weakened along with the development of a modern capital market. But still, we see effects. For example, even today, they share the governance mechanism. For example, they hold monthly president council, or they have a partial cross ownership of shares, and they do personnel exchanges. So today in Japan, we observe 6 big keiretsu groups. In each group, about 20 to 50 companies are members from different industries. So you can see approximately 200 to 300 companies belong to one of the 6 big keiretsu groups in Japan.
There's a clarificatory question, Dr. Mori.
Sure.
It's about the nature of the sponsors. Gaurav Saha is asking who these sponsors are. Are these the ones who are the major investors?
So sponsor is a creator of REIT. So they source properties into REITs. So often these are real estate developers or retail companies which own many properties. And they also own some shares of REITs, but just a small amount. So sponsor is not the major shareholder of REIT itself in most cases.
Thank you.
Okay. So let me go back. So research question of this paper is very simple, straightforward. So does business group affiliation affect profitability of Japanese REITs? So basically, this paper is about the test of risk sharing hypothesis. In Japan, where weakening effect of business group affiliation on general corporations has been reported. But we are hypothesizing that this effect of a business group affiliation is reviving with the J-REITs because of the external management structure, as I explained. So contribution to the literature includes, we are trying to reveal the case in which the business group affiliation still plays important roles, even in a country where the significance of a business group has generally weakened. And we are testing the effect of business group affiliation along with the external management system of REITs. So the results have implications for new REIT markets in many countries: Brazil, China, India, Mexico, Singapore, South Korea, and Thailand, where we also observe business groups. So in terms of data, we focus on all REITs that ever existed in the market. And after deleting some REITs with incomplete data, our final sample consists of 75 J-REITs. Among 75, 23 REITs have sponsors that belong to one of 6 big keiretsu groups, and we call them keiretsu REITs. And 52 are REITs whose sponsors do not belong to any of 6 big keiretsu groups. We call them non-keiretsu REITs. So basically, we compare several profitability measure or risk measures between these keiretsu REITs and non-keiretsu REITs. And we collected the data from these data sources. Okay, so before talking about the methods, is there any other questions, Prashant?
No, we are good. Thank you.
Okay. So as I said, this is a simple test of a risk sharing hypothesis, but we tried many different methods. Okay, so first method is the most basic one. We look at the profitability itself and also standard deviation of profitability for the overall period. And we compare these measures between keiretsu REITs and non-keiretsu REITs. Second, we wanted to so one of the implications from risk sharing hypothesis is that when some companies are in trouble, other company may rescue. And when some companies are enjoying very good profit, some other members may exploit the profits. So we wanted to focus on this tail, so extremely high or extremely low portion of a distribution of a profitability. To do that, we first regress profitability on size, half year, and REIT fixed effects. Then this squared residual are kind of an unexplained portion of the profitability. So we examined if this unexplained portion of the profitability, or we call it the conditional variance, is different between keiretsu REITs and non-keiretsu REITs. We also looked at the stock return volatility, focusing on idiosyncratic volatility and systematic volatility in different market conditions. Then,
sorry, some clarificatory questions. Fawaz Khalid is asking, what is the frequency of data?
So the REIT publish reports is semi-annually. So the data frequency is a semi-annual.
Mm-hmm. And the conditional variance versus idiosyncratic volatility. So it's just about the regression model that you're using, right? So what is the difference?
But here we use a profitability, like a fund from operation. Mm-hmm. This is a volatility from stock return. Yep.
Okay. And what proportion of these REITs were public for which you have stock data?
Sorry?
Public. What proportion of these were public? Yeah.
All 75 are public. Yeah.
Okay.
Yeah. We focus on public REITs.
Okay.
Okay. Thank you. So then we wanted to look at the response of profitability and capital structure to exogenous shock. Okay. So for the exogenous shock, we looked at this Great Eastern Japan earthquake that happened on March 11, 2011. Okay, but we looked at the earthquake, so it's important to control for seismic strength of REIT properties. So we take care of this. I'll talk more about this. And we use these approaches called the difference in differences and propensity score matching to measure the response of profitability to exogenous shock and compare the response between keiretsu REITs and non-keiretsu REITs. And we apply the same method to see the response of capital structure after the earthquake, such as loan-to-value ratio, short-term debt ratio, long-term debt ratio, and cost of debt. Okay, so let me talk more about this earthquake because this we focus on this exogenous shock. So this Great East Japan earthquake happened at 2:46 on March 11 of 2011, and the magnitude was 9.0. And epicenter was approximately 230 miles from Tokyo. And even Tokyo experienced level 5 plus, a quite big earthquake. So at this time, I was in Tokyo attending the REIT forum, really. Then everybody in a cafe of an office building just run away without paying a bill, and we just ran to the park. So the earthquake, even in Tokyo, was really big. So here, this is a map of Japan. Epicenter was here, and Tokyo is around here. But you can see all areas with a red or dark brown experienced quite a huge earthquake. And this earthquake was followed by tsunami and a nuclear power plant breakdown. As a result, 15,897 people died, and still 2,534 people are missing. So anyway, we focus on this earthquake as an exogenous shock to the profitability of REITs. But since, as I said, since we focus on earthquake, it's important to control for the REIT properties strength against earthquake, because maybe keiretsu REITs may own properties that are stronger against earthquake than the properties owned by non-keiretsu REITs. Okay, then we cannot really extract the effect of business group affiliation. The effect might be coming from the difference in the strengths of properties against earthquake. But the good news is REITs disclose this seismic strength measure called the PML, probable maximum loss, which measures the ratio of expected physical loss as a proportion of the building's replacement cost corresponding to earthquake that could happen once every 475 years. So we are talking about a huge earthquake that could happen with a 10% chance in 50 years. So that's the same as this 475 years. Okay, and so REIT disclose this PML score for each properties they own, and also they disclose this portfolio level PML, also considering a geographical diversification. So we collected this portfolio level PML for each REIT from their semi-annual reports. So that's a great control for the seismic strength of REIT properties.
Gianluca Matarucci is asking, is the seismic risk the same in all the areas of Japan, or some areas are expected to be more?
Yeah, some areas have a higher risk. So this, in calculating this PML score, of course, they look at the location of the property and perceived earthquake risk of that location. But compared to other countries, all Japan or any area of Japan has a relatively high risk of earthquake. Yeah, thank you. Any other question at this point?
So I was wondering,
yes,
if PML is correlated with the seismic zoning in Japan, especially for institutional level properties.
Okay, so what do you mean by seismic zoning?
So, okay, sorry, that's an Indian jargon.
Okay.
So,
okay.
So some like Professor Matarucci says that different zones have different earthquake risks intensity.
Yes.
So wouldn't the PML of these localities be correlated with the level of risk?
Yes. Yeah. So I think so. In calculating PML, so PML is calculated by third-party engineering companies. They look at many factors, including the building physical feature and the location, and this the earthquake risk of the area itself. So I think this zoning is one of our big factors affecting PML. So I think that there's a high correlation between this zoning and the PML score.
Yeah. So in other words, the PML could be confounded by the location of the properties. So maybe it's not so much about PML as it is about where keiretsu's properties are located.
Right, it's possible, yes. But we try to control for location kind of a diversification factor. But even before that, in calculating this portfolio level PML, they look at the geographical diversification as well. So that takes care of our some of our issue. But of course, I'll show you descriptive stats, and you'll find that the location of properties between keiretsu REITs and non-keiretsu REITs are quite different, as you guess. So I think it's important to control for it. Yeah, good question. Thank you. So now I'm going to show you the descriptive statistics. So here, I'll show you a few tables from now. In this table, when you see yellow color, that means the value of keiretsu REITs is higher than the value of non-keiretsu. The green means the value of keiretsu is lower than value of non-keiretsu. So you can see that, for example, the fund from operation to total asset ratio, the profitability is higher with keiretsu REITs than non-keiretsu REITs. And this is the volatility of profitability. So volatility of profitability is lower with the keiretsu REITs than with non-keiretsu REITs. So if you simply look at these two, then this supports the risk sharing hypothesis. But of course, this difference may be coming from a difference in farm characteristics or property characteristics, or location, as Prashant asked, or shareholders characteristics. So actually, if you look at the farm characteristics between keiretsu REITs and non-keiretsu, they are different. Keiretsu REITs tend to be larger, dividend yield tend to be lower, leverage ratio is lower. They have a longer history, loan cost is lower. If you look at the property characteristics.
Masaki, in the previous slide, I was wondering, for keiretsu REITs, it's obvious that the loan cost is lower because a bank is a part of the keiretsu.
Yeah, and also leverage.
Why would the leverage be so low?
They're conservative, I guess.
They're conservative. Okay.
Yeah. But the difference in leverage itself is not huge, only 3% difference. So on average, in this study period, the LTV of Japanese REITs are kind of relatively low in any case. Okay,
is the standard deviation cross-sectional or time series?
Yeah, this is a cross-sectional, yep.
So
cross-section all over the study period.
Okay.
Okay, so then this table shows the property characteristics for keiretsu REITs and non-keiretsu. So you can see that keiretsu REITs tend to own newer property, larger properties, occupancy rates tend to be higher, and the keiretsu REITs tend to own more office, retail, and logistics, and keiretsu REITs own more properties in Tokyo and big three cities, which are Tokyo, Osaka, Nagoya. And the last one is very important for a study, PML score. So if this number is lower, the portfolio of property has a stronger against earthquake. So you can see that the keiretsu REITs own properties that are stronger against earthquake compared with properties owned by non-keiretsu. So these differences may be causing this. Instead of a business group affiliations, we try to control for these differences. Okay, and before showing the result, shareholder characteristics, keiretsu REITs shares are owned more by financial institutions, banks, that kind of makes sense, and less by other institutions, individuals, and foreign investors. So now I'm going to show you the results starting from the most basic regression. So volatility regression for overall period. So as Prashant asked, this is a cross-sectional regression. So dependent variable is a standard deviation of profitability ratio, fund from operation to total asset. Numbers are annualized and shown as a percentage. So you can see that the model 1 doesn't include any control variable. Model 2 includes farm characteristics as control variable. Model 3 adds property characteristics controls as well. But you can see that even with all the control variables, this keiretsu dummy, which takes the value of 1 if the reads are keiretsu reads, and the value of 0 if the reads are non-keiretsu, this keiretsu dummy has the significant negative coefficient, okay, even with all the controls. So to give you the idea about this size, so you can see that if the keiretsu sponsor belongs to business groups, then the volatility of profitability is lower by 0.45%. And then average volatility among non-keiretsu REITs is 1.51%. So this reduction means a 30% reduction. Okay, so that seems to support the risk sharing hypothesis because we controlled for these characteristics. And then here, we looked at the profitability itself. Okay, so main risk sharing hypothesis is about the volatility of profitability, but we wanted to see the effect on profitability itself as well. So dependent variable here is a FFO to total asset. So this is a panel regression. Then without control variable, you can see that the keiretsu REITs showed higher profitability than non-keiretsu. Okay. But if you keep adding controlled variables, if you control for farm characteristics and property characteristics, this difference disappeared. Okay, so this higher profitability observed with the keiretsu REITs is coming from farm characteristics and property characteristics. So after controlling for it, it disappears. So there's no impact of business affiliation on profitability itself. But if we go back to the previous table, even with these control variables, we see the effect of business group affiliation on volatility of profitability. Okay. So now this graph shows the cross picture of profitability ratio. And you see two lines. The blue line is for keiretsu REITs and red dotted lines for non-keiretsu REITs. So if you only look at the central tendency, they're similar to each other, profitability itself. But if you look at the tail portion, you can see that non-keiretsu REITs has a much longer tail, especially in a negative direction, but also here. So basically, we wanted to conduct a formal test focusing on this tail portion of distribution of profitability. So to do that, we first ran the regression of profitability on size, half year, and REIT fixed effects, as I explained, and squared residuals from the first regression is a dependent variable for this. So we looked at the unexplained portion of profitability. We call it the conditional variance. Then we compare it between keiretsu and non-keiretsu. Then you can see that even with all the control variable here, actually this keiretsu dummy shows the significant negative coefficient. Okay, so this suggests the existence of a mutual insurance arrangement among keiretsu member firms. So it looks like if the REIT sponsors belong to business groups, then when they enjoy extremely high or low profitability, then other members are kind of absorbing these extreme situations. So that's why the tails of distribution becomes shorter. So that's a sign of a mutual insurance arrangement as suggested by risk sharing hypothesis. Okay, and we also looked at the effect on stock return volatility, looking at the idiosyncratic volatility and the systematic volatility. So in this table, I'm showing the result of two regressions in one table. So first, dependent variable idiosyncratic volatility. Second row is for the regression when dependent variables is a systematic volatility. And for each regression, I included all the control variables already. So then you can see that keiretsu dummy has no effect on idiosyncratic volatility, but you can see that the keiretsu affiliations reduced this systematic volatility. This is important because systematic risk is the risk that is priced. So it's important even for institutional investors with a diverse portfolio. But then if the REIT sponsor affiliated with the business group, this systematic volatility is reduced. This suggests that maybe this group affiliation in the case of REITs may increase the firm value. Okay. And also,
we have a comment from Professor Mataruchi.
yes.
He says keiretsus may have also a reputation effect because the sponsor is from a big group.
Yes.
Normally, this certification effect matters the most for young and small REITs. Once the REIT is listed for several years and large, probably it matters less. Did you try any interaction effect between keiretsu dummy and the REIT's age or size?
Oh, that's a good point. I haven't tried it. So, but one thing I tried is we tried a rolling regression to see the keiretsu effect is stable over time. So rolling, I don't know, I forgot the period, but so we look at the sub-sample periods. Then we found that for the study period we focused on up to 2018, this keiretsu effect has been very stable. So, but beyond this point, like after 5 years or 10 years later, as you said, maybe the effect of this will be smaller. I agree. That's a good point. Thank you for your comment.
I have a minor observation regarding nomenclature of conditional variance. After Robert Engel got his Nobel Prize, I was wondering if calling it conditional variance is appropriate. Could you call it something else, like unexplained variance or something?
Yeah, maybe. Yeah, I took this name from another published paper, but maybe name is not really appropriate. I guess I have to change. Yeah.
Okay. There's another question from Vishuan Wong. She's asking, do you consider the strength of the keiretsu relationship, that is sponsor ownership or length of relationship?
Yes, so sponsor ownership. So yeah, that's a very good point. So that's really kind of a fundamental hypothesis behind our research. So if the relationship is stronger, the effect should be stronger. So as one of our robustness checks, we looked at heterogeneity of the result based on sponsors' ownership of shares. And we found that when the sponsor owns more shares of REITs, they have a more control, while relationship is stronger. Then we found that this risk sharing effect was stronger. So yeah, your guess is right.
Thank you.
So with the stock return volatility, we also looked at this effect separately for up market and down market. Up market is when REIT market, Japanese REIT market was booming, going up, and down market is when Japanese REIT market was going down. And we found that this effect is mainly coming from down market. In up market, the effect is not strong, but when the market as a whole is going down, is in trouble, then keiretsu REIT enjoyed a reduced systematic risk. Okay, so again, this supports risk sharing hypothesis. Risk sharing saying that the REITs, when the REITs are in trouble, other members try to help. Okay, so from here, I explain the result of the response to exogenous shock, response to the earthquake. And I'm gonna use the propensity score matching and the difference in differences method. So I heard that today we have a participant with a different backgrounds. So if you are not familiar with the propensity score matching and the difference in differences, I'll try to give you an intuitive explanation. But if you want to study more, then I highly recommend this book, Mostly Harmless Econometrics, the most readable econometrics books I've ever read. And in my opinion, this is the best econometrics book. And the main author is Dr. Joshua Angrist. He just won this year's Nobel Prize, one of them. Okay, so I highly recommend this book. Okay, so to look at the response to earthquake, responsible profitability to earthquake, even before any formal analysis, I just simply looked at the time trend. So the blue line is for keiretsu rates. So the y-axis is a profitability ratio, and the blue is a keiretsu, and the red dot is non-keiretsu. So you can see that even before earthquake, there's a difference. So they are different. Okay. But the response to earthquake was also very different. So non-keiretsu rate, so earthquake negatively affected both keiretsu rates and non-keiretsu rates, but the negative impact was greater with a non-keiretsu. But this difference may be coming from characteristics difference or difference in properties strength against earthquake. So we tried to control for these factors. So for this, the response to earthquake analysis, we tried a tighter control using propensity score matching. So idea of propensity score matching is based on these factors like size of the farm, LTV, occupancy rate, and the PML. This is the most important measure, the property strength against earthquake, and the percentage of properties in Tokyo to control for location factor. So based on these variables, we calculate the probability that each REIT is treated as keiretsu REIT. Some REIT is assigned like 80%, okay? And if this probability calculated based on these factors is similar to each other, they are similar to each other in terms of these variables. For each 15 keiretsu REITs, we tried to find non-keiretsu REITs whose score probability is similar to the probability of keiretsu REITs. So that's the kind of a basic idea of a propensity score matching. So as a result, we got a 15 keiretsu REITs and 15 non-keiretsu REITs. They are similar to each other in terms of these factors. So in the table, you can see values of these variables before matching and after matching. So you can see yellow rows, these value between keiretsu and non-keiretsu becomes more similar to each other. And focusing on this paired sample, we ran the regression. Okay, but before the regression, I again recreated this graph using matched sample, so after matching. So here, before matching, this one, after matching. So even before and after earthquake here, so these two lines became closer together because we found similar non-keiretsu REITs for each keiretsu REIT. So matched pair are similar to each other, matched pair are similar to each other, but right after earthquake, response was really different still. Non-keiretsu REITs, negative impact of earthquake was much greater with a non-keiretsu REITs than with a keiretsu REITs. And more formally, we use a difference in differences approach. So because this difference may be coming from difference in profitability existed even before event. So basically, DID, difference in differences, control for the difference before event to examine the difference after event. So pre-event is from 2002, second half of the year to second half of 2010. So we took this a short pre-event period to avoid the influence of a global financial crisis. And a post-event is basically 2011 because the earthquake happened March of 2011. Then you can see that this is a DID factor. So controlling for the difference we observe even before the event, the impact of earthquake on keiretsu rates. So negative impact was much smaller with keiretsu rates. Okay, both, so earthquake negatively affected both non-keiretsu and keiretsu. But if you look at the keiretsu after earthquake, we got a positive significance. So this tells you that the negative shock to keiretsu rates after the earthquake was absorbed by a keiretsu affiliation. And we applied the same approach to see the response of these capital structure variables after earthquake. So again, you can look at this DID factor. So no effect in terms of LTV, loan to value ratio, but you can see that negative coefficient with a short-term debt. So keiretsu rates were able to reduce the proportion of short-term debt after earthquake and increase the proportion of long-term debt after the earthquake. And again, no significant without increasing the cost of debt. So this result basically implies that keiretsu rates were able to stabilize the capital structure, shifting more short-term debt to long-term debt without increasing cost of debt under uncertain situation created by the earthquake. So that's the implication from this table. So as a robustness checks, we did try many things, including this. So for the volatility regression, we also included property type variables like office, retail, those variables. And we tried rolling 10-year periods regressions to see the effect is stable or not. And we tried the simple, most basic regression, even with the matched sample. And also, as I said, we tried the interaction effect of a sponsor ownership, and the results are all consistent with the risk sharing hypothesis. So in summary, basically we found evidences supporting risk sharing hypothesis using different methods, and evidences are notable, especially with an abnormal portion of the profitability, and also with a response of profitability to exogenous shock. And we also found that during the crisis, the keiretsu rates were able to extend the maturity without increasing cost of debt, probably because of a relationship between their sponsor and bank. And I didn't explain this part, but I know it's in a paper. But we also found that right after earthquake, keiretsu rates was still able to originate new loans by affiliated banks, but the non-keiretsu rate had a trouble originating new loans right after earthquake.
Dr. Mori, this is slightly late, but
Okay.
in India, REITs are new, and we still do not have any FFO implementation here.
Okay.
So just for the clarification of the audience, if you could talk about what is FFO and what is your proxy for profitability here?
So FFO is a kind of a profitability measure we often use for REITs, and it came from the United States. And it's similar to ROA of a general corporation, but starting from ROA, we add depreciation because REITs own the real estate properties, hoping that the value of the property will increase. So because that's their job, they invest in commercial properties. So subtracting depreciation doesn't make sense. So for that reason, for REITs, we add back depreciation, and also we subtract any profit from the sales of the properties. So occasionally, REIT sell the office building, for example, but this profit is included in ROA, but we exclude this profit from sales of properties because we consider that's a temporary part of a profit. So from ROA, we make basically two adjustments to get the FFO. And people say that the FF4 is more suitable to measure the profitability of REITs. Okay, good
Although
question.
it is still controversial because in the US, most
Yep.
REITs do publish FFO, but
Yep.
then different REITs have heterogeneous treatment of various accounting practices like rent straight lining, etc. And
Right. Yeah, that's the issue. So even for this study, we manually calculated FF4 by ourselves, following our own definition, starting from ROA.
Okay, thank you.
Good question. So, implications are effective mutual insurance of keiretsu group affiliation seems to exist. And it seems important to understand the role of business group affiliations for externally managed REITs in certain countries, including Japan. So that's all of my presentation. So thank you very much. I'm happy to take any question and comment.
So while we await questions from the audience, I was wondering what is the legal recognition of keiretsu? Because it appears that it is not a legal entity per se. It's just a group of companies coming together, dominated by a lending institution.
Right.
So,
so there's no legal framework for keiretsu. So it's a really informal groups. So to identify keiretsu membership, we have to look at the different sources. So some people examine the roots of many countries, and they publish, in this keiretsu group, these companies are members. But so it's kind of a subjective judgment in the end.
Yeah, so that makes me wonder if J-REITs are also a good laboratory to test for strong form efficiency in companies. Because if they are not a legal entity, then there may not be restrictions on insider trading. So I can be a part of the keiretsu, but not necessarily affiliated to a REIT, but I may have insider information. So I may trade on that information later on. And that could also be an interesting research question to test.
Yeah, I guess it's kind of risky to call it insider information, but in group information, I would say insider trade is anyway illegal in any case.
So I mean, you're not legally an insider if you are a part of, let's say, lending institution, which is a part of the keiretsu. So you may be privy to a lot of insider information.
Yeah, but regardless of a membership, if you have access to insider information, then that's illegal. So
okay,
you gotta be careful.
Okay. So Dr. Mona Shah is commenting that while keiretsu may be an accepted way of doing business, in India, we may also attract the attention of the Competition Commission. So this is like, so how would this informal arrangement be viewed in India? So I'm not sure if you would be ready to answer this question, but this is a good question to ponder upon. So she's hinting at insider trading too.
Yeah, my knowledge about Indian corporation is limited. So even in Japan, so from a regulator perspective, it's a difficult task. I think that they recognize the advantage of this keiretsu, but also they have to promote a fair competition, of course. So on the surface, they can limit the proportion of cross shareholdings or these kind of things, but it's clear that they are allowing this existence of a business group keiretsu. So we have both advantages and disadvantages. But as I said, if you look at the general corporations in Japan, the effect of keiretsu is becoming weaker and weaker because of course we are having a more fair competition in the market. Right, but I'm saying that with the REITs, suddenly we see the revival of this business group effect because of the external management system.
Sorry for the interruption. Divesh Pandey, our research associate at Mishra Center, is asking a relatively basic question. Do the proportion of international institutional investors in REITs affect the returns on REITs? That is the rate of return, FFO, reputation, etc. And if they do, are they different for keiretsu and non-keiretsu?
I haven't examined that research question with the J-REITs, so I can't give you the accurate answer. But my guess is, I'm not sure if that affects the profitability, but it might affect the volatility. I mean, the return, but it might affect the volatility because foreign investors are more liquid. They put money and withdraw money easily. So maybe the return volatility becomes higher, but I just guess, sorry.
Yeah, because this question is relevant. I see that in Japan, foreign assets are allowed, and in India, foreign assets are not allowed. But anyways, that is not about the investors.
Prashant, can I ask one question?
Please do.
Masaki, the way I understand that you are seeing the risk sharing is happening within the groups if you have a business group on top of it. Okay, but can it happen in bidirectional also?
Okay. Could you explain a bit more?
What I'm saying that what was in the paper, what you are explaining is that if in the picture you show that several ships are in different shapes and they do share risk, and this risk sharing is much more, I think, less volatile or they are less vulnerable if there is a group company on top of it. Okay, but what I'm saying that as if that risk sharing happens from the REITs to the parent.
Oh, I see.
And if that happens, then your indicator could be endogenous.
Right. So compared with members of keiretsu, within the keiretsu members, REIT may be one of the smallest companies. Okay. The size of REIT is really small compared with other member firms. So I wouldn't imagine the large effect going from REIT to other members. But yeah, you are right. Yeah, that's a good point.
And if I could jump in here, Abhiman, I guess unlike, if my understanding is correct, keiretsu is not a parent company as such. It's just an agglomeration of different companies which have come together. So, but I guess the issue of endogeneity may still be there. That leads me to another question related to profitability. But here, your measure of profitability is based on FFO, which is after leverage cash flows. So the route through which keiretsu helps is mostly on the financing side and not on the performance of the asset itself. So,
asset, yeah, the effect from asset side may exist as well, because the keiretsu REITs may be more easily attract good quality tenants, which may be member firms as well.
I see. Okay.
Right.
Yeah, that's an interesting angle as well. Now, just to trivia, one of my PhD students recommended this book, and I got this book recently. You have a copy
mine too.
Now we will be reading a Nobel laureate that we didn't know about. I do not see any additional questions here.
Okay.
So I take this opportunity to thank you, and I'll hand it over to Dr. Abhiman Das.
I think, do you see any more questions? No. Okay.
No.
Okay. So thank you, Professor Masaki, for spending time with us and sharing your very, very interesting research. In fact, these questions are quite fundamental, sometimes very hard to explain, what drives the volatility of the profitability. The distinction between profitability and the volatility of profitability itself is extremely important or extremely fundamental. And through this risk sharing hypothesis, you could prove that it works, I think it's quite fascinating. So we'd look forward to your, I think, involvement in our center activities. Involvement means I'm talking about, I think, having a research collaboration at some point in time, working with you, maybe in a couple of new things. What we are experiencing in India, REITs are very new here, and possibly these things will open up several new research questions, and we should be able to take it forward with your support. Thank you very much.
Thank you so much for kind comments. I'd love to have a collaboration with you and your colleagues in the future. Thank you so much.
Thank you, everyone. Thank you, all the attendees. We will soon be announcing our next webinar. I hope to see you there. Dr. Mori, if you could just stay for 2 more minutes.
Okay, sure.
So we could please stop the recording now. So just a moment. Dr. Murray, we are going to organize a panel discussion through webinar in December.
Okay.
We have invited Dr. Barry Bloom. He's the president of Xenia REIT. He also helped us with some case studies at EHL earlier. And then we have the CEO of India's first REIT, which was sponsored by Blackstone. Now the Blackstone has moved out. And I don't know how it will go, but it will be great if you could join as one of the panelists as well, for a simple reason that you bring in know-how of Asian REITs, both Singapore and Japan. And maybe you could add value to that discussion as well, if you're interested.
Yeah, if you think I can make any contribution, then I'd be happy to join, of course. I'm interested in learning Indian, the REIT market as well. So it's gonna be my pleasure to do that.
Okay, so
but please think carefully. So if you find a better person, then please replace me with that.
Not at all. Right now, I'm thinking aloud because Abhimana and I have not discussed it and just took the liberty of discussing this with you because you were here. But we will let you know if we feel like inviting you. Thank you for agreeing to.
Yeah, thank you.
And I think, Masaki, there was one first question somebody was asking, do you know Adam Koo?
Yeah, I saw